Hello and welcome to our Deep Dive Explainer. Today we're tackling one of the most critical and honestly one of the most complex parts of India's Income Tax Act, Section 9. This is all about income that's deemed to accrue or arise in India. And trust me, this is where cross-border taxation gets really, really interesting.
So let's kick things off with a scenario you've probably thought about. Picture a foreign tech company, let's say a software as a service provider. They have absolutely no office, no employees, no physical presence in India. But they have millions of Indian users paying subscription fees. So the big question is that revenue taxable in India? This isn't just a textbook problem. It's a huge issue for global businesses today.
Well, the answer to that question lies in a powerful and pretty clever legal tool known as the deeming fiction. This is the absolute core of Section 9. It basically allows the law to create a legal connection for tax, even when a physical one doesn't exist. It's how the tax law is trying to keep up with our borderless digital world. So here's our game plan for today. We're going to start with the concept of the deeming fiction itself, what it is, and why it exists. Then we'll explore the four main ways the law establishes a connection. After that, we'll dive into specific types of income, see it all work with a practical case study, cover some crucial compliance points, and finally, we'll wrap it all up with the key takeaways you need to know. All right, let's jump right into our first section, the deeming fiction. Before we get into the nuts and bolts, it's really important to understand the why behind this whole concept. So what on earth is deemed income? Put simply, it's income that the law treats as if it arose in India, even if, in reality, that money never physically touches Indian soil. The whole point of Section 9(1) is to create what's called a tax nexus, basically a strong enough connection that gives India the right to tax income that's clearly linked to its economy.
Okay, so now that we have the why, let's move on to the how. In Section 2, we'll look at the four key connections that trigger this deeming provision. And let me tell you, Section 9(2) casts a very, very wide net.
Right, so these are the four big pillars. Income gets caught if it flows from any asset, property, or source of income that's located in India. It also applies to the sale of a capital asset that's situated here, but the one that's the most expansive and frankly the most debated is that third one, the business connection. The idea of a business connection isn't set in stone. It's always evolving. It's not just about having an office or an agent in India anymore. The law now includes this concept of a significant economic presence. This was brought in specifically to address the digital economy, to target businesses just like that SaaS company we talked about, that can make a ton of money from India without having a single desk here. Okay, so we've got the big picture. Now, let's zoom in and get into the nitty-gritty. In this next section, we're going to break down how the Act applies specific rules to different kinds of income. First up, salaries. Under Section 9(3), things are pretty straightforward, at least at first. If you perform services in India, the salary you earn for that work is considered Indian income. Simple enough, right? And that even includes any related leave periods. The second rule is also key. If the government of India is paying a salary to an Indian citizen, it's taxable in India, no matter where in the world that person is actually working. All right, next up, dividends and interest. For dividends, the rule is crystal clear. If an Indian company pays it, it's deemed to be Indian income. End of story. For interest, it gets a little more nuanced. The key is to look at who is paying the interest. If it's the government, an Indian resident, or a non-resident paying for their business in India, then that interest is deemed to arise in India. But, and this is a really important exception, if a resident borrows money but uses it for a business entirely outside India, the interest they pay on that loan is not deemed to be Indian income. And now we come to two of the most heavily debated areas, royalties and fees for technical services, or FTS. Now, similar to interest, who the payer is matters a lot. But for royalties, there's an extra layer. The payment has to be for the use of intellectual property in India. For FTS, the test is even more specific. It all comes down to where the services are utilized. So if any technical, managerial, or consulting services are used in India, the fee for those services is considered Indian income. It doesn't matter where the work was actually done. Okay, theory is great, but let's make this real. How does this actually work in practice? In Section 4, we're going to walk through a case study to really connect all these dots.
So let's break this scenario down. You've got a firm in Singapore designing a building for a client in Mumbai. Let's say the work is done in Singapore, the contract is signed there, and the payment is made there. But, and this is the absolute crux of the matter, where are those architectural designs being used? They're being utilized for a building in Mumbai.
Because of that, under Section 9(7), the fee paid to the Singapore firm is deemed to rise in India, and it becomes taxable here. This is a perfect example of that powerful utilization test in action. So, understanding the law is half the battle. The other half, making sure you're compliant. In this section, let's talk about some practical steps you need to take and some common mistakes people make. Think of this as your practical checklist. On the compliance side, you should always check if a double taxation avoidance agreement, or a DTAA, might offer some relief. Document everything, especially where services are being utilized. And of course, figure out if tax deducted at source, TDS, applies. Now, for the pitfalls. The biggest one is assuming that no physical presence means no tax. As we've seen, Section 9 makes that a dangerous assumption. Others include not appreciating how broad business connection is and misclassifying a payment as, say, FTS when it's really a royalty. These mistakes can be costly. All right, we've gone through a lot today. Let's pull it all together and recap the absolute key takeaways from this explainer. So if you remember nothing else from this session, please remember these 5 things. 1. Section 9 is a legal fiction designed to link income to India. 2. The idea of a business connection is incredibly broad, and it's getting broader. 3. When you're dealing with royalties and FTS, utilization is the magic word. 4. This is the big one. You do not need a physical presence in India to be taxed here. And 5. A crucial point of procedure. You always check taxation under Section 9 first. Only after that do you look to see if a tax treaty, a DTAA, offers any relief. And that really leaves us with a big forward-looking question. With concepts like significant economic presence constantly being interpreted and expanded, the arm of Section 9 is only getting longer. It really forces us, as professionals, to ask, are our international business structures, or those of our clients, truly ready for this reality of taxation without borders? And that's a wrap on our deep dive into Section 9. Thank you so much for joining us. If you found this explainer useful, we'd really appreciate it if you could like, subscribe, and share it with any colleagues who might also find it helpful. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.